Ben Thompson, Deputy CEO of Mortgage Advice Bureau. And in this session, I'm going to look at how the market adapted through 2020 in the later life lending market to continue to serve customers. In the first part, I'm going to have a look at how growth in the later life lending market has played out over the course of the last 5 years in particular. What we have seen in the last 5 years is a number of factors change. Obviously, there's been a lot of change in terms of demographics and the aging population, demands on pension schemes and various other things. But of course, we've seen a lot more competition in terms of new funding coming into the market. And we'll look upon the effects and the positive impact of that later. But fundamentally, what we have seen is a steady, progressive pace of growth across the later life lending market throughout the course of the last 5 years. And that's very much set to continue, as we will see. In terms of growth outlook, pre the pandemic, if you look at Mintel's forecast on the market, we can see very consistent and strong growth forecasted. In fact, we're looking at a market that's probably going from somewhere like 2 or 3 billion up to around about 10 or 11 billion by the year 2024 in 3 years' time. That was adjusted, obviously, in terms of after the pandemic, but even so, the forecast in terms of outlook from a number of different providers and experts, not just Mintel, are quite bullish around growth in the later life lending market. So Mintel in isolation was still looking at a good almost 6 billion by 2024 and a progressive and growth path between now and that point in time. Other providers obviously have different forecasts in terms of the outlook, but all of them are consistently showing a bigger market. What we've also seen, as mentioned at the beginning, is competition has increased significantly in and amongst funders and lenders. So if we go back only 5 years ago, some of the new business rates on later life lending products per se were close to 6%. And it's obviously in previous decades to that, more expensive still. But what we've very much seen, of course, in particular in the last year to 2 years, has been a very significant downward trend on shift on pricing. So as we've seen some of the new competitors come into the market, people like More to Life and Legal & General, we have seen significant competition and downward push on prices. Also, we have different funder types behind the product design as well. And that's really good for customers and clearly benefiting them, but also growth prospects for market as well, as it becomes much more of a viable product at that price. And then actually looking at the reasons why people are actually needing later life lending, well, we've had to kind of adapt, I guess, as an advisor community to recognise the slight change and shift in what people are looking for now. We've had the COVID pandemic for pretty much a year. So if I jump back in previous years, a lot of it was quite lifestyle driven. People maybe just drawing stuff, yes, to help kids and intergenerational support, but also things like leisure and holidays and that type of thing. Aspirational spend. What we're seeing emerge, and we've had to adapt to recognise over the course of the last 12 months in particular, is people are now looking to maybe repay debt more. They're also looking to help their children and intergenerational, I suppose, relatives out, if you like, in terms of gifting. And those two patterns are emerging to become much stronger drivers for why people are actually drawing money and how they've adapted over the course of the last 12 months since the onset of the pandemic. And I suspect that will probably continue. Nonetheless, it adds on to the other drivers as to why the market is growing. And that's obviously a good thing in terms of us as an advisor community. But we have had to adapt to recognise that, and that will probably continue. So why are people now needing later life? Well, again, just having a look, yes, we have seen intergenerational help and people repaying debt, but we're also seeing now an increasing number of interest-only mortgages coming up for, I suppose, expiry or their natural cessation. So if we look back to when interest only was a very major driver in the residential mortgage market through the early to mid-2000s, peaking in 2007, what we're now seeing is a lot of those mortgages are coming up at the end of their term, and they're actually set to peak. I think it's in the year 2032, which is a good symmetrical 25 years after the market peak of 2007. And those opportunities are going to increasingly come up year on year, as you can see from this slide. And as an advice community, again, we need to probably adapt to recognise and spot those changes and those opportunities in particular, as whilst many people will sell a property or move or downsize or repay through their own resources, there'll be a huge amount of people who won't be able to do that and will need to adapt to buy a new type of later life product as well. There's an opportunity for us to adapt as an advice community to work more closely with perhaps the more traditional mortgage advisors who have that type of borrower in their customer bank, because obviously we have solutions in our later life armory that can very much help those people. And if you actually look at those numbers in particular, they run up to 2033, you'll see there's very big numbers coming off at the end of term. So as an opportunity looking forward into coming sort of decade to 2 decades, there's lots of new business to be written there where people won't have repaid their interest-only mortgage. The other point I just flag, if you look to the right of the slide, is the average mortgage size of products coming off interest only. They're over 100,000, which is probably about 20,000 more than the average later life product as well. So a good opportunity and a decent chunk of equity in people's properties as well, as you can see. So it's a real opportunity for those in the market today, and clearly it's going to get bigger still. And if I also have a look at the pension situation, obviously it's been very well documented that later life as a general market is going to increase because of people who've under-provisioned in terms of pension. What we're basically seeing is that is very much the case, and there's a bit of a sort of a regional as well as a national snapshot there. There's a general sort of heading, as I think we all know very well. Pensions are underfunded, and again, we need to continue to adapt to recognise that that's going to be an increasingly emerging trend going forward, and property wealth is going to have a bigger part to play as we look forward into coming decades as well. In addition to that, what we're looking at is obviously, if we look at a sort of snapshot of people who are planning about their future, if you like, in terms of care funding, if we look at some of the statistics down the left-hand side, that will show you aspirationally what people are looking for in terms of long-term care. So we're looking at sort of, 15% was about 18 months ago, I think it was, of over 55s have no idea how they're going to pay for care. Close to 2/3 want to actually receive care in later life in their own homes. And that's a figure that's only going to get bigger after COVID-19. And we could look at some of the other stats on there. Obviously, this is going to be a big gap for people. And again, just to sort of drive the growth in the later life lending market, we need to adapt to recognise that customers will need some answers as to how they're going to fund this in future. And again, property wealth very much comes into play. And I expect this to be an increasing trend and themes and driver in terms of why people are taking later life lending products as we move forward. And I think probably the questions in terms of how we've had to adapt our advice and our whole stance in the last 9 to 12 months since the onset of the pandemic. I've mentioned lots of areas where there are emerging themes and changes around drivers for why people are taking later life. But fundamentally, I think one of the top points is to have a look and make sure that any advice we do give is relevant for the longer term as well as the shorter term. I think what we have seen is a lot of people have put in urgent requests for product because of immediate distress in family, for example. And it may well be that later life is the right thing to take as a general product set to help intergenerational family, if you like. But sometimes it's good advice is actually to do nothing for now, or do something different, and then maybe look at the later life product again in a few months' time, which might sound a bit odd. It's recognising it in these funny times through the pandemic. People might be taking product for the wrong reasons, so we need to recognise that, and also vulnerability, which I'll talk about in a second. Other areas, obviously, again, everyone will be doing this anyway, but I think sort of deeper fact-finding questions are going to be areas where we need to be stronger, and I think everyone will be doing this already anyway, but just to really understand what's the genuine driver behind taking a product, so we can really spot where there may be vulnerabilities. And I think probably just channel choice is another, how people take their advice. We kind of had our hands forced because of lockdown, where sometimes remote, so telephone and video is the only way to see people, and that can really have its plus sides because you can reach a lot more family members, for example, through Teams or Zoom or LoopUp or Blue Jeans, sort of video comms, if you like. But of course, face-to-face arguably is your richest form of advice because you're really with someone and understanding what they're wanting and why they're needing a certain product. So again, we probably need to adapt to recognise how people are going to want to take that advice in the future and make sure we can service them as an advice community accordingly. And then I talked about vulnerable clients, and I'm not going to go into great detail in terms of any of this data on this slide, or just as a general point, what I want to get across is I think because of COVID-19, because of impact on the various generations, because of the long-term picture in terms of care and aging demographic, we have an increasing responsibility as a advice community to completely adapt to recognise and help vulnerable customers. Because what we're seeing in this data here, just to summarise, is pretty much every advisor is seeing this more and more, and I very much expect that to be the case. So we'll need to adapt as an advice community to know how to spot vulnerable customers, to know the questioning techniques to try and understand the problems that vulnerable customers may have, and then be able to respond in the right way when we believe we've come across a genuinely vulnerable customer. So a really important area that we expect to talk about in future meetings and future conferences. It will only become more and more important, and we need to recognise and look after customers like that. And I mentioned channel choice, and this is a really important area. Again, as I mentioned, I think the industry has evolved, and we've had to adapt to try and help people with things like digital signatures, remote advice processes, desktop valuations. Advisors themselves have embraced technology in new ways that we never would have thought of only a year ago. And I think it's been absolutely fantastic what the industry as a whole has done, but there will clearly need to be more. And it's also recognising when you meet customers virtually, can you spot properly that they're potentially vulnerable? Or is it really a face-to-face meeting is a better decision as and when obviously lockdown restrictions are released? But again, we're adapting, we're recognising, and these are things that we'll continue to face going forward. So I think probably in summary, what I'd like to say is that this market genuinely promises to be pretty thriving in coming years for lots and lots of different reasons. So at the front end, we've got lots of really good competition in terms of funding. That will only continue. I've talked about the drivers behind the market, why the market will continue to grow. And there's lots of very good reasons behind that, be it long-term care, pensions, intergenerational support. Growth is in this market for a long time to come. We do need to adapt our advice practices and processes and channel of choice in terms of advice itself. And obviously, really, technology will probably have a part to play to simplify and enhance the process more as we look forward, probably recognising more genuinely vulnerable customers and to make sure we provide the right advice solutions to them as well. But in summary, the market is set to grow. Yes, it's been a very, very difficult 9 to 12 months, but the outlook for this market is very strong. So long may that continue, and I wish you a very successful 2021.